Hello everyone and welcome to Educate 247. This is the third lecture in the series on economic and social issues, and today we'll be covering MCQs related to Finance Commission. This lecture is important for RBI, NABARD as well as SEBI examinations. Now before moving forward, Educate 247 brings you SEBI Grade A 2020 crash course, which features around 5000 plus MCQs with concise content and live doubt sessions to help you. To avail the benefits of this course, you can log on to the website and apply coupon code SEBI to get 1500 rupees off on the course. Now, before moving on to the MCQs, let us understand more about the Finance Commission. So, what is the Finance Commission? The Finance Commission is a constitutional body which is formed every 5 years to give suggestions on center state financial relations. Each Finance Commission is required to make recommendations related to sharing of central taxes with the states, the distribution of central grants to states, measures to improve the finances of states to supplement the resources of the panchayats and the municipalities, and any other matter which has been referred to it. Over the years, the core mandate of the Commission has remained unchanged, though it has been given the additional responsibility for examining various issues. For example, the 12th Finance Commission evaluated the fiscal position of states and offered relief to those that enacted the fiscal responsibility and budget management laws. The 13th and the 14th Finance Commission assessed the impact of GST on the Indian economy, while the 13th Finance Commission also incentivized states to increase the forest cover by providing additional grants. The current, which is the 15th Finance Commission, was constituted in November 2017 and is to recommend the central transfer to the states. It has also been mandated to review the impact of the 14th Finance Commission recommendations on the fiscal position of the center, to review the debt level of the center and the states, and study the impact of GST on the economy. So, why is there a need for a finance commission? The Indian federal system allows for the division of power and responsibilities between the center and the states. The center collects majority of the tax revenue as it enjoys scale economies in the collection of certain taxes, while the states have the responsibility of delivering public goods in the areas due to their proximity to the local issues and needs. Sometimes this leads to states incurring expenditure higher than the revenue generated by them. Further, due to vast regional disparities, some states are unable to raise the adequate resources as compared to others. To address these imbalances, the Finance Commission recommends the extent of central funds to be shared with the states. Prior to 2000, only revenue income tax and union excise duty on certain goods was shared by the center with the states. A constitution amendment in the year 2000 allowed for all central taxes to be shared with the states. Several other federal countries, such as Malaysia, Pakistan, and Australia, have similar bodies which recommend the manner in which central funds will be transferred to the states. The extent to which the central government transfers the funds to the states depends on a number of factors, which include income distance, the population factor, the index of infrastructure, the tax efforts, as well as the fiscal discipline. Over the years, finance commissions have used population data of the 1971 census. The 14th Finance Commission used the 2011 population data in addition to the 1971 data, while the 15th Finance Commission has been mandated to use data from the 2011 census. Area is another criteria, as a state with a larger one has to incur additional administrative costs to deliver services, while income distance is the difference between the per capita income of a state with the average per capita income of all states. States with a lower per capita income may be given a higher share to maintain equity among the states. Another important factor is the forest cover, which indicates that states with large forest covers bear the cost of not having area available for other economic activities. Therefore, the rationale is that these states may be given a higher share. Besides the tax devolved to states, another source of transfers from the center to states is in the form of grants in aid. As per the recommendations of the 14th Finance Commission, grants in aid constitute around 12% of the central transfer to the states. The 14th Finance Commission had recommended grants to state for three purposes, which included disaster relief, a case of revenue deficit, and in the case of local bodies. Now, coming to the MCQs, who among the following establishes the Finance Commission in India? And the options are A. President, B. Finance Minister, C. Prime Minister, or D. The Parliament. So the correct answer here is A, that is, it is established by the President. Under Article 280 of the Constitution, the President is required to constitute a Finance Commission at an interval of 5 years or earlier. The Finance Commission has a chairman and 4 members which is appointed by the President. The Government of India provides the necessary support and manpower, including a secretary, to the Commission to help facilitate its work. Moving on to the next question. Which of the following is not correct? A. The first Finance Commission was constituted in 1951. B. The chairman of the first Finance Commission was Mr. Santaram. C. The chairman of the 12th Finance Commission was Mr. C. Rangarajan. Or D. Both B and C are not correct. So the correct answer here is B, that is, the chairman of the first Finance Commission was Mr. K.C. Neogi. He was also a member of the Constituent Assembly of India and a member of the Cabinet of the Independent India. The first Finance Commission recommended that the share of states in the proceeds of the income tax will be around 55%. The first commission recommended that the share of states in the union excise duties will be around 40% of the proceeds of the tax. All the recommendations which were made by the commission were accepted by the union government. Moving on to the next question. Which of the following roles, functions, and responsibilities are not under the purview of the Financial Commission? First, sharing of net proceed of taxes between the center and the states. Second, recommending principles for governing the grants in aid to the states by the center. Third, recommendations on matters referred to it by the President for the interest of sound finance. Or fourth, that the preparation and periodical revision of electoral rolls is being done by the Finance Commission. So the options are only first, B, only second, C, only third and fourth, or D, only fourth one. So the correct answer here is D, that is, the preparation and periodical revision of electoral rolls is not a part of the Finance Commission and is done by the Election Commission of India. The Finance Commission takes care of sharing of the net proceeds of taxes between the center and the states, as well as recommends the principle for providing grants in aid to the states as well to the local bodies. Moving on to the next question. With reference to the Finance Commission, consider the following statements. As the Finance Commission is a constitutional body, its recommendations are binding on the government. Second, the chairman of the Finance Commission is not eligible for reappointment. Which of the statements given above are correct? So the options are A, 1 only, B, 2 only, C, both 1 and 2, or D, neither 1 and 2. So the correct answer here is D, that is, neither of the statements given is correct. The recommendations made by the Finance Commission are only advisory in nature and thus they are not binding upon the government. While secondly, it is up to the union government to implement the recommendations of the Finance Commission on granting money to the states. While in case of the appointment of the chairman of the Finance Commission, he is eligible for reappointment. Moving on to the next question. On which of the following subjects does the Finance Commission of a state constituted under the Part 9 of the Constitution of India make recommendations to the government? First, the distribution between the states and the panchayats of the net proceeds of taxes by the states. Second, the determination of the taxes which may be assigned to or appropriated by the panchayats. Or third, the grants in aid to the panchayats from the consolidated fund of the state. So the options are A, all the three are correct. B, only 1 and 2 are correct. C, only second and third one is correct. Or D, Only 1 and 3 is correct. So the correct answer here is A, that is all of them are correct. The recommendations of the Finance Commission will cover the distribution between the state government and municipalities of the net proceeds of tax, duties, the toll and fee as levied by the state. It also includes the allocation of share of such proceeds between the municipalities at all levels in a state. It includes the determination of taxes, duties, tolls, and fees to be assigned or appropriated by the municipalities, and the grant in aid to municipalities from the consolidated fund of the state. So we have completed the MCQs related to Finance Commission for this lecture. Before ending it, I'd like to tell you about that Educate 247 brings you a comprehensive course for RBI Grade B 2020. It is a full video course which covers all the relevant topics such as economic and social issues, finance and management, along with a coverage of current affairs. So you can log on to the website to avail the benefits of this course. So thank you and happy learning.